Many people are predicting that we'll get to a gold-silver ratio of 50 times. That means that silver will continue to outperform gold. So if we get to a gold-silver ratio of 50, it means that 50 ounces of silver would buy an ounce of gold. But if we go back to the 1920s, the gold-silver ratio was less than 20. Now, can you imagine, let's say that gold gets to $5,000 and the gold-silver ratio was just 20 times. In other words, 20 ounces of silver buys an ounce of gold, and gold is $5,000. Did you get that? Have a guess? So if gold is $5,000, it's not $5,000 yet, it's 4,300. If gold is $5,000 and you need 20 ounces of silver to buy an ounce of gold, all day yesterday and today, my telephone has been buzzing with alerts from TradingView. Now, I've got these alerts from TradingView set up for years and years, and they're supposed to tell me when the gold price moves more than 0.5% in an hour, or more than 2% in a day, and things like that. And it doesn't usually give me a signal, but in the last 24 hours, it's been going buzz, buzz, buzz as we get a signal. Gold is up 0.5%. Then an hour later, gold is down 0.5%. And then gold is up 2% in a week. And then gold is down 0.5%. Then it's up 2%. It was kind of all over the place. So what this was showing was unusual volatility. The gold price is swinging around much more than usual. So yesterday, can you remember what the gold price was when we spoke yesterday, young man?
4,100.
That's right. It was 4,100 yesterday. Have a guess where it was before I started this video.
4,300.
It was, yes, it was actually. It was actually, before I started the video, I saw the price was $4,340. So we're, what, $240 above the price when I started the video yesterday. So what we're really seeing now is what I've talked about is $100 swings in the gold price.
Geopolitical and trade tensions are fanning gold's rally. The U.S.-China trade war has escalated with fresh tariffs on shipping, disrupting global logistics and raising costs. Retaliatory measures have shaken confidence in supply chains, forcing shipping companies to reroute and investors to hedge against unpredictable fallout. Meanwhile, the Federal Reserve has adopted a more dovish stance, with rate cuts expected at the upcoming October 25th meeting. Lower interest rates typically weaken the dollar and boost gold prices. These overlapping factors, trade friction, monetary easing, and rising geopolitical strain, are reinforcing gold's appeal as a strategic hedge.
And I think this is the first time I've seen a $100 swing, but I think we're going to see many more $100 swings going forwards, both up and down. Now, gold is up 62% year to date. So that's beating, I guess it's beating NVIDIA, I'm not sure, but it's certainly beating NASDAQ and the Dow Jones and many other assets. And it's very well supported. So what's going on in the world which is supporting gold? Well, we've got the escalating US-China trade war. Obviously, the latest salvo was with the Americans imposing taxes and duties on Chinese ships arriving in American ports, and the Chinese retaliating by saying they're going to do the same thing to American ships arriving in China ports. So unfortunately, there's a little fly flying around. Unfortunately, the plan to reinvigorate American shipyards by hoping that international shippers will buy American ships instead of Chinese ships has kind of backfired. Now, international shippers will buy neither American nor Chinese ships. So good luck to those countries which have got shipyards outside of America and China. I'd love to know if the Vickers shipyard in the UK is still open, working. I don't know. What else is going on which is called supporting gold? We've got the geopolitical uncertainty, instability, really. We've got the dovish Fed. You know what dovish means? It means they're going to, I'll explain because you don't know. Dovish means that the Federal Reserve is more and more likely to reduce interest rates. The expectation is that it will reduce interest rates by 0.25% in the October meeting, which I think is on the 25th of October. But some governors, particularly Governor Miran, who's the appointee of Donald Trump, is supporting a 0.5% cut.
Markets rarely warn before they break. Economists call these unpredictable shocks Black Swan events. They strike suddenly, triggering massive repricing in assets. Whether it's a sovereign default, a cyber attack on financial infrastructure, or a surprise policy shift, investors often buy gold quietly in anticipation. The current rally could be the market's early response to brewing risks that haven't fully surfaced. Historically, gold demand spikes in the months preceding crises, not after. In an era where geopolitical flashpoints are multiplying from Eastern Europe to the South China Sea, this silent positioning may be signaling something larger ahead.
I've just noticed a lot of mosquitoes here. Just killed one there. Also, we've got investor uncertainty with investors who are starting to slip. Oops, let's put that back up again. We've got investor uncertainty with investors starting to look at other alternatives to stocks and a general flight to safety. But one thing I'd like to just say, I put a headline on yesterday's video and it stimulated a lot of conversation. The headline was, Black Swans don't send invitations. So what's a black swan event? A black swan event is something that happens that you weren't expecting, that nobody expected. It comes out of nowhere and it causes stock markets to crash or the price of something to change very rapidly and by a large percentage. So the point is, a black swan, and by the way, you know swans are white, so it's very unusual to see a black swan. So when you have a black swan event, it doesn't send out an invitation saying, hey, next week we're going to have a stock market crash, or next week we're going to see some country somewhere go completely bankrupt. It doesn't tell you in advance. So we could have a black swan event coming. My comment was, black swan events or black swans don't send out invitations. But what do they do instead? They buy something in anticipation of that bad news. And what they buy is gold, which may explain the gold price going up. There could be signs, early signs, that we're going to have a black swan event of some kind. I don't know. On the back of gold rising, we've got silver rising strongly. The gold-silver ratio, which was over 100 a few months ago, is now at 80.5. What that means is that silver has been relatively stronger in price than gold. Something's going by making a lot of noise here. There's a man, you'll see that dragging something very heavy. So gold has been relatively strong compared to silver. So
while gold captures headlines, silver has been quietly outperforming. Earlier this year, the gold-silver ratio exceeded 100. Now it's near 80. Historically, periods of high ratio have preceded powerful silver rallies. Analysts predict a potential return to a 50-to-1 ratio, and some even speculate on levels seen in the 1920s, below 20-to-1. If gold reached $5,000 and the ratio narrowed to 20, silver could theoretically hit $250 per ounce. Though such levels are distant, silver's relative strength underscores investors' growing interest in hard assets, especially as industrial demand from green technologies surges worldwide.
Many people are predicting that we'll get to a gold-silver ratio of 50 times. That means that silver will continue to outperform gold. So if we get to a gold-silver ratio of 50, it means that 50 ounces of silver would buy an ounce of gold. But if we go back to the 1920s, the gold-silver ratio was less than 20. Now, can you imagine, let's say that gold gets to $5,000 and the gold-silver ratio was just 20 times. In other words, 20 ounces of silver buys an ounce of gold, and gold is $5,000. Did you get that? Have a guess? So if gold is $5,000, it's not $5,000 yet, it's 4,300. If gold is $5,000 and you need 20 ounces of silver to buy an ounce of gold, what would the price of silver be? How would you work it out?
So I would do like 20 divided by 5,000. So firstly, I do 10 divided by 5,000.
You mean 5,000 divided by 10?
Yeah, 5,000 divided by 10. Then I know that you just take away a 0, so that's 500. Then divided by 2, because it's 20, equals 250.
Beyond precious metals, other commodities reveal a complex picture. Oil prices have softened, with West Texas Intermediate down nearly 20% year to date, partly due to larger U.S. inventories and hopes of easing Eastern European tensions. Wheat and other agricultural prices sit at multi-year lows, providing relief on inflation metrics. Meanwhile, copper has risen over 13% this year, a sign of underlying industrial resilience. These crosscurrents suggest that while consumer price inflation may appear contained, deep structural shifts in global supply, demand, and trade could quickly change that outlook if any shock occurs.
So the price of silver would be $250. Well done. So can you imagine if we get back to the historical ratio of below 20 or 20 times, and gold by then is $5,000, your silver price would be $250. So is $250 a possible price? Absolutely, it's possible, but it'll take some time to get there. We don't know if we'll get there. But I think the next stop that people are looking at is a gold-silver ratio of 50 times. We're coming down from 100 times. We're at 80 times now, on the way to 50. What else is going on in the world? Well, the price of crude oil continues to fall. Now the price is $57.60. That's less than yesterday. West Texas Intermediate is down 19% year to date. Why is the oil price going down? Well, the reason it went down yesterday was some news that the US crude inventories are larger than expected. But of course, if the Ukraine conflict gets resolved, we'll see a lot more Russian oil coming onto the market. And then, of course, we've got the trade war going on.
What's Russian oil?
Russia produces a lot of oil. It produces huge quantity of oil, but because of the sanctions which were imposed by the United States after they invaded Ukraine, it means that it's much more difficult to sell that oil, so they're probably not producing as much as they used to, and what they're producing, they're presumably not able to sell it, at least not directly, to Western countries which have imposed the sanctions. So all this oil is probably being stored up in Russia in storage facilities as opposed to being sold. But if and when the conflict with Ukraine is resolved, those sanctions will get lifted, and if the sanctions are lifted, then the Russians will be selling all their oil to the West, which means there's more oil. And what happens when there's more of something? The price goes up. Are you sure? If there's more of something, the price goes down. Oversupply.
The bond market is sending clear signals. 10-year U.S. Treasury yields recently dipped below 4%, reflecting investor demand for safety. With the Federal Reserve expected to cut rates by 25 or even 50 basis points, short-term yields may soon align lower, reversing the current inversion. Historically, such periods have preceded economic downturns and gold rallies. As equities face selling pressure, capital is rotating toward treasuries and precious metals. Whether driven by geopolitical strain, monetary easing, or looming black swans, gold's volatility may be the early warning bell for bigger financial tremors ahead.
So that's another factor. And then, of course, last but not least, we've got this trade war with America, where both sides are imposing huge duties or fees on each other's ships, starting on the 1st of November for, I think, either with China or America, or maybe both of them. So that's creating chaos in the shipping market because the ships are having to reroute themselves and all kinds of things. So I don't know what that's doing to the oil price. One more other comment, copper. Copper is up 13% year to date, which does indicate that there's some robustness in the economy. But agricultural commodities like wheat are trading at the lowest level since 2020. So low oil prices, low wheat prices or agricultural commodity prices are good for the consumer price index, means that the official inflation rate, the number that the Federal Reserve looks at, probably isn't rising as much as would be justified by the huge rise in government debt and money supply. So people are selling equities a little bit. Money is heading into US Treasuries. And we saw last night that the yield on the US Treasury, the 10-year, dropped below 4%. It's now 3.9% yield to maturity. Now, let's just remember the federal funds current rate is 4% to 4.25%. That means that the yield on 10-year Treasuries is now below the short-term overnight rate. But that rate's almost certainly going to change at the end of October, 25th October. It's going to change from 4.75%, 4% to 4.25. It will change to a new band of probably 3.75 to 4, which will mean the short-term rate is slightly below the 10-year rate of 3.97. And of course, there is the outside chance that the rate cut at the end of October will be 0.5% cut instead of a 0.25% cut, which would take the new band down to 3.5 to 3.75. And don't forget, we've got at least one person at the Federal Reserve, Governor Miran, appointed by Trump, who's advocating for a 0.5% cut this month.